All right, so we're going to do a couple of bond examples. So the first one I want to do is one with a discount. So it's 1223. So we issued a 8% 20-year bond with a face value of 130,000. Bonds are issued at 86 and pay interest June and December. So let me pull up Excel here. There we go. We issued the bond for $130,000, but it was not purchased for that amount because our interest rate is lower than the going interest rate. And so in order to sell our bond, we had to discount it. So the first thing I want to do is calculate how much cash I received. And I'm going to multiply my face value times the issue. So I only received 111,800. However, I have to pay back the full 130,000. This journal entry does not balance. The difference is called discount on bond payable. Okay, so and it's just going to be the difference between these two, so my journal entry balances. So I have an $18,200 discount on my bond payable. So I'm going to do a straight line amortization. What I want to do is take this 18,200 and I'm going to divide it by the number of interest payments I'm going to be making. So if it's a 20-year bond and I'm paying twice a year, I'm going to make 40 payments total. So my discount, I'm going to amortize every 6 months is going to be $455. So that's the journal entry for the sale of the bond on 6/30. So let me go ahead and do my first interest payment on December 31st. So the first thing I want to do is go ahead and calculate how much cash I'm going to get rid of. Let me just do that real quick. So that's going to be 130,000 times, I'll do 8%. Now this is going to be the annual interest payment, but I'm not paying a whole year's worth of interest. I'm only paying half because I pay every 6 months. So that's how much cash I'm getting rid of with a credit. Now with the discount on bonds payable, if this is on the debit side and I need to make it smaller, I'm going to go ahead and put it on the credit side. So it's going to be 455. And then my interest payable is going to be these two, the sum of these two together. I'm sorry, not interest payable. It's going to be interest expense. If I haven't paid it, if I paid it, then it would be interest expense. Okay, so I'm going to make this every 6 months until I have fully amortized my bond and I have to pay that bond back. So let me go ahead and do an example of a premium. Let's see. So I'll just do the premium here, which is number 3. So we have a 70,000 10-year 9% bond, and number 3 says we're going to issue it at 103. So it's the same theory. So let me go ahead and do this one now. So let's figure out how much cash we're going to receive. So it was a $70,000 bond, and it's at 103%. So I'm actually getting $72,100. I have to pay back just the 70,000. So I have to put something on the credit side now to make it balance, and that's called a premium on bonds payable. And again, it's just going to be the difference, so it's 2,100. So I'm going to amortize it the same way, straight line. So it's a 10-year bond that I'm paying interest on twice a year. So I'm going to go ahead and take my premium of 2,100 and I'm going to divide it by 20. So I'm going to go ahead and amortize that bond $105 each time I make an interest payment. So let's go ahead and figure out what our interest is going to be, our interest payment. So it is a $70,000 bond. and it is a 9% interest rate. So if I did this, that would be an annual interest rate, but I'm paying semi-annually, twice a year, so I'm going to go ahead and divide that by 2. Then the next one is our premium on bonds. So again, if this is on the credit side, to make it smaller, I'm going to debit, and we said that was going to be 105. And then our interest expense is going to be the difference between these two, because now I have to make that balance. So our interest expense is going to be $3,045. So that is how to do a premium straight line amortization.